Super expensive Okay, anyway, super expensive people will still buy. Why? Because they have their
Bro, what are you doing? Got flies
dodging back please. This one. Welcome back to Let's Invest. So today we'll talk about how to avoid bad companies.
That's very important because there are actually a lot of different type of business for us to actually invest, but there are certain type of business that we want to avoid totally if you don't want to lose money.
Yep.
So what's the first thing that you look at?
That reminds me, if we were going to a marriage, we are going to find a partner of life. So would you want your partner to be in huge debt?
Of course not.
Definitely not. Yeah. So I think that's the same case in investing. You would not want to invest your hard-earned money in a company with high debt. So just like when you're with your partner, let's say he's getting a 500 million debt, will you feel comfortable staying with him or her throughout the rest of your life? Throughout the rest of your life. That goes the same with the company.
Well, actually depends, right? If your spouse, right, got 500 million debt, but the asset is 1 trillion, that might be a
different story.
But let's say your asset is just like 600 million, but the debt is like 500 million. That's bad, right? So you have to like put things into perspective. So in terms of business, right? Yes, we usually don't like a business with high debt, but of course as perspective to the entire asset of the company.
Yes.
So there's this particular ratio, right? It's very, very important, right? We compare the company's debt with the company's asset. This is what we call the debt to equity ratio. So my personal benchmark debt to equity ratio is not more than 0.5. Let's say the company got $1 million of debt, the equity, also the net worth of the company, right, should be at least 2 million. So it's like less than half because if the debt is 1 million, but then the net worth or the equity is let's say 500,000, means the company to bankrupt 2 times, just to pay back. That is very dangerous.
Or if you get a little bit confused, let me put it into a life example. Let's say your spouse or partner have 5 million of properties, but then he's owing the bank 10 million debt.
Wow.
So that's what we call a high debt situation. That
also means that they have negative net worth.
Yep, definitely. Yes. So look out when you're investing or choosing a partner. Okay, hopefully your partner is not having this kind of situation.
Yeah, don't get blinded of the 5 million worth of asset.
Yes.
You must ask how much debt you have. Okay,
yes.
That's very bad.
Yes, that's the most important question in marriage. Second thing I would say it's... Now let me give you an example. Please pass me your hand.
My hand?
Yes. Not asking you to marry me. Come. Come. If I hold your hand, let's say for 5 minutes, your whole hand will go color, right?
My face will go red.
Yes.
What do you want?
Anyway, when your hand go purple, so that means your blood is not circulating throughout the body.
Flowing, okay.
Yeah, so what we say in investment, the cash is the blood of a company.
Oh, I see. So you want a business that have cash flow lah?
Yes, especially. If not, either the company face will go red or the hand will go purple. It's either one.
So that's this one criteria which we need to check out is this thing called the operating cash flow. We want to check whether the business actually collect back money from a customer. It's very, very important.
Yes.
Because there are certain businesses that never able to collect back cash from customer. So this is what we call kiam xiao, in Hokkien. Owe money, owe money. O-W-E, money, owe money.
Okay, now I understand.
So, of course, after collect the cash, right, we want a business to actually expand.
Yes.
Right? So, business usually have this expenditure called a capital expenditure. So, let's say the company actually collect 100 million. They use this 100 million to actually grow or maintain the business. Now, this capital expenditure, right, of course, we want them to actually grow, but at the same time, we don't want them to actually overgrow.
Yes.
Or what we call overexpansion.
Yep.
So, for example, let's say they have like 100 million cash. We don't want them to actually use all the 100 million cash to actually grow, because what if fail?
What if they need cash?
Yes. Using this operating cash flow, right, minusing all the capital expenditure, the growth of the company, the maintenance of the company, what's left is what we call the free cash flow. So we always want the company to have some sort of free cash flow so that they are more free.
Flexible.
Flexible. That's a better word. So they can actually give out like dividends, or maybe they can pay off their debt.
Cushion for, let's say, the current situation.
For potential market crash, that kind of thing. So if you actually learn something, right, 1 or 2 things that is very important, maybe do help you to actually like the video, right, and to share these 2 very important criteria to your friends so that your friends will avoid investing in this company, right, with high debt or with bad cash flow, right?
Yes.
And of course, maybe you can comment below, some of the ratios or some of the criteria that you personally will look out for when you're actually investing.
So the first 10 person who comments in the comment section get a chance to host Alex Hands.
Bro, my hand is for you only. My hand is for you only. Okay, anyway, other than the high debt and bad cash flow, we want to invest in businesses that have high competitive advantage.
Yep.
Or in Warren Buffett term, he call it good economic moat, which means that they have pricing power to actually increase price to actually charge the customer, and they are not worried that the customer will actually run away.
Yep.
If a business don't have competitive advantage or don't have economic moat, they are not able to actually charge high price to a customer, and this is something that we want to avoid. For example, some of the commodity businesses, like for example, if I'm selling
Oil and gas products,
gas,
petroleum.
let's say I'm
benzene.
selling oil and gas, right? And you're also selling oil. So what's the
Yes.
difference between our oil?
If you sell your oil, people can hold your hand. I think you can sell better.
Stop holding my hand. I'm not giving you my hand for you to hold. My hand is for you. Yeah, I mean, let's say rice is still a commodity, am I right? So what's the difference between your rice and their rice? It's still rice. So there's no clear differentiation about the company's product, and because of that, it's very difficult for them to actually increase their price to actually sell to the customer. So in terms of profitability wise, it's very poor.
Yep.
So imagine if in terms of profitability wise, the business is making lousy money, and at the same time bad cash flow, okay, no cash coming in, and yet to make it worse, high debt, wow, 销了, done.
I give you an example. A company that has very, very good competitive advantage.
Oh, okay.
This phone,
What is this food?
iPhone. So sibei expensive
Terbalik.
Okay, anyway, sibei expensive, people will still buy. Why? Because they have their mode, their
Yeah.
competitive advantage. So that also leads to a higher profit margin compared to their peers.
Yeah. So, bro, Apple can buy or not?
Apple phone cannot buy.
Can invest in a company lah.
Depends on the price lah.
Actually, this is a very good point.
Yes.
Even you found a good company, right, with good let's say for example Apple, right, with good cash flow and low debt, we always want to check what's the valuation of a business, because if it is overvalued, it doesn't matter how good is a business, what's the growth potential, we never want to invest in a business.
Yes.
Right, because we don't want to invest in good companies but bad investment. Of course, we want to avoid bad company, bad investment. We only look for good companies with a good investment. Means what? Good company, low debt or no debt, good cash flow, good free cash flow, good pricing power, good mode, at the same time undervalued. Especially during this period, too many undervalued opportunities out there for us to actually take action. Maybe a quick recap of what we learned today. Avoid investing in high debt businesses, high leverage, right? Especially get out of leverage debt to actually fund for their growth, and bad cash flow, right? Unable to actually collect back cash from our customers, that's very bad. And no pricing power whenever they need to increase price, right? That is very bad. We want to invest in business that anytime can increase price and the customer still back for their product and services. That is very important.
Yes.
Like for example, Apple, right? Increase price, people still queue up to buy iPhone, right? That's very powerful. And of course, we want to invest only when it is undervalued. So if you actually learned something, again, please like, okay, and share our video to more people around you. And do remember to actually turn on the notification bell, ding ding, so that you will miss out the future videos that we will update to you.
Yep.
And do comment below at least what are the things that you actually will take note, okay, before you actually invest, or some of the things that is a no-no for you before you actually invest. So hope to see you again in the next video, and we'll see you soon. Bye bye.
Goodbye.